All right, so we're live. So thanks very much for everyone jumping on to, I think, what we loosely called last time Burke Britton Quarantine TV. We're back for episode 2. And as we promised last time, we'd bring in some other thoughts from around the Burke Britton world. Today we've got Hamish Foletta from Sarto Advisory, founder and CEO. A lot of our clients will have, a lot of our Geelong clients will have met Hamish at our Christmas event. Maybe some of our regional clients haven't had a chance to meet Hamish, so you're lucky enough to have him today. We were just chatting off air before. I asked Hamish, "You've gone into work, Hamish? Is that right? You were a bit worried."
That's it. It's the first time in the office for a little while.
That's just so you can avoid the kids for a little while.
That's it. Yeah, I thought I'd better try and avoid having 3 little boys running in on the conference call.
Yeah, good move. So yeah, as we said, we thought we'd grab Hamish and get some of his thoughts around the current sort of market conditions, what's happening, and just off air before we came on board, we were sort of talking about some of the common questions that people are asking at the moment and the impact on markets, people's psychology, and things like the government response. And also some of the interesting history of bear markets. So maybe, Hamish, if we sort of handball over to you, maybe we can recap on some of those key questions that people are asking, and also sort of the history of bear markets over time.
Absolutely, yeah. Thank you, everyone. So I appreciate your time. So yeah, I think that there are probably 3 key questions that are going on with investors at the moment. So firstly, what is the duration of the virus impact, or specifically the economic hit? So the analysis that I have seen is that, so actually let me just start with the 3 things and then I'll drill down to each of them. So firstly, what is the duration of the economic hit? What is the government response to this economic hit? And then thirdly, what are the longer term implications of businesses and investor behaviour? So firstly, just in terms of the duration of the economic hit, the analysis that I've seen is this could be anywhere from 8 weeks to 6 months, depending on each country's way that they have approached this, whether they sort of go into hard lockdown or something that is less dramatic. So at the low end, at sort of more the 8-week situation, you've got a place like China, and then at sort of the high end, you'll probably have emerging markets where this could go on for some months, and then perhaps it looks like Australia is more toward the Chinese situation and the US is sort of somewhere in between. But that economic hit appears to be somewhere between sort of 2 to 6 months. Secondly, you've then got to think, what is the government response to this? And I think in particular in the last week, this has been the biggest relief is that there just appears to be bipartisan support globally that this is an unforeseen event, and governments need to sort of do everything they can to try and assist businesses to get through this period. So I think you've seen response from central banks cutting interest rates, flooding the market with liquidity, and then more recently governments announcing various fiscal responses to try and support businesses and individuals. So that has been really important, and I think that's been one of the reasons why markets have improved over the last week. And then the third key question is, what are the longer term implications of this crisis on people's behaviour? People perhaps not wanting to travel overseas as much. Obviously, businesses minimising travel, people working from home. Will people dine out as much? Long-term hygiene, those sorts of things. So they're sort of, I guess, in my mind, what I'm thinking about with those key questions. You mentioned about the previous bear markets.
Yeah.
Okay. Perhaps do you want me to show you a few thoughts around that?
Yeah, I think so, and I think it's something that I've talked loosely, and I know Peter and Ben have, about sort of the history of bear markets and sort of the duration, and I think it's a pretty interesting thing, because in a lot of respect, people feel like this is something that's forever. That the sky's falling in. I always like looking back at the headlines of bear markets gone by, and it's almost the same headline gets brought up every single time. The sky's falling, the world's going to implode, we'll never recover. Yet the world recovers, and there's some pretty good history there. So yeah, maybe if we jump into that, Hamish, that'd be great.
With that, well, sorry to jump in as well. We haven't had this, we haven't had a coronavirus shutdown impact like this, and it doesn't mean that we have no data that can help us see through that. Like, all these different events impact the market in a similar way, which is the hard thing for people to probably reconcile with. So seeing in what you're about to show us is different events causing these impacts, all different and all having similar impacts in the market. So the market sort of sits a little bit differently to the actual events. So I think that's the key for people to understand. It isn't unprecedented, has been thrown around a lot, but probably for the market, it's maybe not. So
absolutely. I mean, this is my third bear market that I have worked through now, and it's everything you say. It's so true. It's so easy to look back in hindsight at the GFC and think what a wonderful buying opportunity, or after the dot-com bust, what an amazing buying opportunity. And then, when markets fall 50%, you just go and buy, because eventually they go up. But when you're actually living through the crisis, there's always something new that comes up to make people think, okay, is it different this time?
Yeah.
But that's why I think it is really, really interesting to look at what has happened in the past, because I think it does sort of help to frame that. So let me just bring up this slide here.
See how good your technical skills are, Hamish.
All right, so let me jump on here. Yeah. You can see that?
Yes.
Okay, great. So this is some information published by a group in the US called Ned Davis, who I sort of use to help me kind of think about markets from a technical perspective. So this is every bear market since the 1900s. So each dot here represents a bear market. And so this black dot here represents what we just went through. So you can see that the market has fallen, this was at the beginning of last week, had fallen about 38%. And this had occurred over a period of just 25 days. And to put that into context, to look at the average bear market since 1900, the average bear market has fallen about 31% versus the 38% that we just experienced. So it fell 31%, but it's done it over an average period of just over 300 days, whereas we experienced a 38% fall in just 25 days. So whilst the fall has not been as large as something like 2009, where the market fell about 54%, 55%, it's certainly been a very large fall. But what's been, I guess, most impactful is just how quickly the market has corrected. So I think you can see from this that, it's already been a very severe fall, which I think is somewhat healthy in that it's indicating that perhaps the market has already moved to price in a lot of the negative news already. The other thing that I just wanted to pop up, after a crash, markets will typically go through a few different stages, and I think it's just helpful to think about this. So those stages would typically be, you go through an oversold process, you then have a relief rally, markets will often then retreat or perhaps retest those previous lows, and that then forms a base for the market to grind higher. So I think when you look at how severe this fall was, my sense is that we perhaps saw that oversold condition. So my sense is that we've perhaps seen that first step. The markets have obviously rallied in the last week or so, and so perhaps this is the relief rally. And so just a possibility, but my thought is that, you know, we do see a bit of a retreat from here. Perhaps we retest the lows that we've seen. And then my hope is that that sort of forms a base for the market to start to move higher from there. So that, just from a technical point of view, that's sort of how I'm thinking about the market, the recent crash that we've just gone through.
So a question, if I might, Hamish. I mean, clearly uncertainty of any sort markets hate, and the rapid spread of uncertainty with the rate of the potential growth in the doom and gloom media perhaps is the reason the markets fell so rapidly.
Yeah.
If we start to see, which we're already starting to see, some positive signs in different places, the market's likely to, again, a question, is the market likely to recover much more quickly than the final positive outcome will be? Does that make sense?
Absolutely, and it's. I'm really glad you raised it, because this is one of the things I wanted to talk about. My discussions with clients have been, my feeling has been that the bottom of the market happens at the point of maximum uncertainty. So not at the point of maximum bad news or maximum worst economic data. It's that point of maximum uncertainty, and that's basically been the case with every single crash in history. And so my sense is that that point of maximum uncertainty was perhaps a week ago, before you had the government initiatives, before all of these global initiatives in terms of trying to contain the spread of the virus. So yes, I'm hopeful that that perhaps that point of maximum uncertainty has passed. And I think the danger with a lot of people is that when they think about the market, obviously the economic data gets a lot worse from here. And I think a lot of people naturally assume that that means that the market will go lower, but that's not necessarily correct. The market will often behave in a different fashion to the economy. And I guess the simplest way to think about that is, obviously the market has been falling in anticipation of the bad news that is now coming. But on the other side of it, the market will be looking for the first sign that the recovery or things have been contained, and will quickly move to price in, the recovery out the other side. So,
but a lot of the worst case scenario could well have been priced in already. Yeah, is that right? Yeah.
That is my gut feel.
Doesn't mean it may not bobble up and down and go a little lower, but a lot of the worst information and the worst uncertainty, we hope, is now behind us.
Sorry to jumping in on that, I suppose the difficulty for people at the moment and for the market to work out is, we look at how we're doing it in Australia and how we're controlling it, what government interventions are coming in. It differs greatly from the US, for example. And so even if we get things under control here, and we're feeling things that, slowly getting better, because we've got such a link to obviously the Chinese economy and the US economy, until there's probably certainty in those areas, the market won't really lose that level of volatility. Is that probably the general feel? We need to wait for the uncertainty in other economies to also sort of clear up.
Yeah, for sure. But I also think, though, even though, again, just thinking about the virus, it would appear that things get worse in the US from here. However, perhaps they have actually past that point of maximum uncertainty there as well, because they can see all of the initiatives that are now being put in place to try and control it. But yes, I would think that, so to me, it feels like we've seen the extreme panic, and so that's now starting to subside, and that's why the market has had a relief rally. But there'll still be bumps along the way as you know, the economic reality sort of comes through, and so we would expect.
Hey Hamish, just given the fact that obviously we've got history, which is obviously an indicator, but it's not always necessarily it doesn't forecast the future necessarily. And you know, we'd all love to have a crystal ball, but I mean, what are some of the things that you think about in terms of sort of mitigating the risk moving forward? So in terms of how you sort of how you manage the portfolios, the types of assets that you're looking at, how do you actually and timing of entering the market? How do you think about how to sort of manage what still is uncertainty and volatility in the market during this period of time, and sort of look to take advantage where possible of the crisis, the crisis that does create opportunity?
Absolutely, yeah. So I think a few things. What I might, in terms of the taking advantage of the crisis, I guess a lot of clients have asked me, when do you start putting money into the market? And obviously, ideally, you put it in at the bottom of the market, wherever that is. But obviously, that's really difficult to know, right? And my gut feel is that if you're looking at putting money into the market, given the falls that we've seen, it's definitely there's definitely a strong argument to start putting money into the market, but don't put all of it in just yet. And so I guess simplistically, I've thought about it in terms of perhaps doing it in 3 different tranches, for instance. As you might do your first tranche straight away, sit back for a little bit, look to do the second and third tranche. The other thing just to keep in mind there, after the GFC, you saw a lot of businesses do these capital raisings, and that's potentially a phenomenal opportunity for investors to get, for retail investors to build exposure to shares at discounted prices. So, you know, a recent example, was Sonic Healthcare, where, you know, they did a share purchase plan. The share price came down, but then you were able to buy the shares at a discount to an already discounted price. And so that becomes a really low risk way of investors building up exposure to the market. So that's one thing to keep in mind. Just in terms of, I guess, building resilience in portfolios, and I guess a key mandate when constructing portfolios for your clients has been about building portfolios that are deliberately long-term in nature. And can you guys still see me? It's just frozen.
All good.
Just me, Hamish. I have to disappear and tell some kids to be quiet. So.
There you go. Yeah, very good. So, you know, building portfolios that are long-term in nature. And so in order to do that, you want to have portfolios that are diversified. So diversified across industries and companies. And the idea of that is, at any one point in time, you'll have some companies that have tailwinds, some companies that have headwinds, and other companies that are grinding through. But on average, you'll have quite a less volatile experience. Now, with the pandemic that we're currently facing, obviously it's somewhat unprecedented in that there's so many businesses that are being impacted by this. However, when you think about how a lot of these portfolios are built for your clients, you know, clearly banks are going to be more affected than businesses like Sonic Healthcare and Medibank. But, you know, so the banks have obviously been sold off harder, and it would appear that, you know, there will be risk to the bank's dividends more so than other industries. But when you blend it all together, the overall outcome will be, you know, a much more subdued impact than, you know, if you had sort of 50% of your portfolio exposed to the banks.
Definitely. I suppose if you're looking to put, someone has an established portfolio and they're looking to feed some additional funds in, at the moment, what sort of companies, or, you know, not specific names, but in terms of what are you looking at on their balance sheet or in their financials that you're looking to get into? Is it, do they need to have low debt levels, or is there any sort of key points that you're looking at?
Yeah, great question. I mean, I think the key thing is making sure that when we come out the other side of this, that the business has a product or a service that's still going to be demanded. You know, and I mean, let's talk about Transurban, which is a company that we own across a lot of portfolios, so toll roads. So clearly that business is impacted as we sit here today. But from a longer term perspective, people are going to continue to drive on those roads. Now, Transurban announced today that they will cut their dividend for this year, but really that's a matter for them to essentially preserve liquidity to get through this current, whether it's 2 months, 3 months, 4 months, whatever. But then as you get through the other side of that, the business will go back to generating the profits that they were and paying the same sort of dividends that they were. So that, I think that is the key, is just thinking about the business that you own and will that continue to be operating, 6 months down the track as we come out the other side.
I think, Hamish, if I can just, a number of questions with clients that have been, worried about what this is going to do to them and their personal value. The question that comes up a lot, am I going to lose my money? Is it all going to go, am I going to go bust here? And I think what you've just said, I think is great for our clients to hear, that if you buy good quality companies, yes, they suffer. Yes, they get dragged back by this emotional, irrational behaviour at the moment, but they'll come out the other side still being strong quality businesses that produce good cash flow, and they'll still be around in a decade's time. And I think our brief with you, our relationship with you has always been to buy good quality long-term stuff that on average will produce okay income and will ride out these times, and we all get belted, but we're not going to get terminally belted and we're not mortally wounded.
Absolutely, exactly right. And I think you think about the diversity that is in your portfolios and you combine that with the other asset classes that you build into client portfolios. In addition to that, when you think about some of these listed investment companies that we have for your clients, the future generations and the global value funds, these sorts of things, the way that they construct portfolios, they will be a lot more resilient in these down markets. In the short term, the share prices have probably fallen as much as the market, but the underlying portfolios will have held up much better, and eventually that will start to be reflected in the share prices. And so I think, to the questions that clients ask, are they going to lose their money? The most important thing is not to sell, right? So the shares are going to go down in value, but we know that at some stage in the future, whether it's 6 months' time, 12 months' time, 2 years' time, we'll look back and say, that was an opportunity. If you've got enough cash and fixed income and safe stuff that you don't need to sell your shares at a time when the market's down, then you're going to be okay.
Probably the links to that a tiny bit, and what we've always, the portfolio is focused around as well, is dividends and the income stream that these companies produce. And I'm sure, as you flagged with Transurban, that there might be some impacts, but broadly, do you think that a lot of them will, stop dividends or reduce dividends to some extent? It's hard to comment. Each one will have its own story, but just broadly a comment on the income production of the portfolio.
Yeah, absolutely. So yes, again, because of the diversity of the portfolios, obviously there will be some companies that will be more at risk of cutting dividends than others. So, the businesses that would seem more at risk would be something like the banks. However, because they have sold off so much, even assuming that they cut dividends, the yields will still look attractive. So perhaps it's already in the price. I think a good way to think about this, during the GFC, the Australian market, on average, there was about a 20% reduction in the dividend of the Australian market. And so I think that's probably a nice simple way to think about it with the Australian share component of your portfolio. If you assume that you'll see 20% short-term reduction in the dividends, but as you come out the other side, those companies will go back to making the same sorts of profits that they did, and the dividends will then increase again.
And even with that 20% reduction in dividends, it's still producing more passive income than the alternatives at this time. So that's probably, we're preaching it all the time, but that's probably the main philosophy is if you're holding on, it's not just waiting for the capital to return, but it's producing income all through that period as well.
That's exactly right. And so a great example would be, so let's think about the banks, because, they're probably the ones that are more at risk. So, with Westpac, ANZ, NAB, I think the grossed up yields there were, call it roughly around 13%. So even if you assume that they halve their dividends, that's probably the more bearish analysis that I've seen. I think generally people would say they might have to cut by 30%. But even if they halve their dividends, then you're still talking 7.5% grossed up yield versus a cash rate of 1.5%.
Zero.
Yeah. And actually, I might just, if I could, bring up this slide, because I think this helps to sum this up. Just can you see that now?
Certainly can. Yep.
So this is probably about a week and a half old, but it will tell a pretty similar story. So this is the purple line here is the dividend, the grossed up dividend yield of the Australian share market going back to 2002, and the grey line is the term deposit rate. And what you can see, from 2000 through to sort of 2007, you broadly got a similar sort of roughly about a 5%, 5 and a bit percent grossed up dividend yield on your shares, and you'd get about the same return on a term deposit. Things got a little bit out of whack here during the GFC, but then you can see that things returned to a similar level pretty quickly. So you're getting about a 6% return on shares and term deposits after the GFC. And then since then, obviously, as everybody knows, the cash rate has been slashed and the return that we're getting on term deposits has dropped dramatically. But the dividend yield that you're getting on shares has remained broadly the same. And so this gap is basically as wide as it's ever been. So, I think that's really important to keep in mind, because yes, there's a lot of bad news out there right now. Let me just get rid of that. There is a lot of bad news, a lot of things to be concerned about, but at some stage, people will go back to getting on with their lives, and you have this situation where shares provide a phenomenal income versus what your alternatives are.
And that slide was a pretty good reflection of the idea of why it's not a good idea to take all of your money to cash at the moment too. You look at that clear separation between the limited amount of income we're going to generate from cash fixed interest, and you combine that with your sort of the history lesson on markets. We know we don't know when the bottom is going to be. So rather than trying to pick it, hold through with the growth assets we have, continue to collect the income. And as we've talked to our clients right through, making sure that in this time we've got ample sort of cash assets to draw that income we need, and it buys us that time to manage through. Now, I'm mindful of time, and I'm mindful that we could talk forever. I think maybe we commit, Hamish, if you're okay with it, to come back for an episode 2 with you, or maybe an episode 3, what happens in the market. But listen, I hope everyone's enjoyed that. I know from the conversations I've had with clients, they love hearing your thoughts on what's going on. So listen, mate, thanks again. I hope you and the team at Sarto continue to be very busy, and I hope on the home front you have a happy and healthy period of time. So thanks again for everything you do for us, and we look forward to speaking to you again in the very near future.
Excellent. Yeah, thanks a lot, guys. And
Thank you very much.
Now, if I can just now if I can work out how to work out the morning. All right, that's
Stop
fine.
it.
Thanks again. Cheers.